Okay, learning objective 2 gets into the first step in our provision process, which is calculating the current income tax expense or benefit. The thing you have to do first in figuring out your current is to figure out taxable income. Taxable income is just book income plus or minus any differences you have, any permanent or temporary differences that you have between the book rules and the tax rules. So we're going to look at in Exhibit 17-3 here, an example of a company, PCC, that we're working with in this chapter. This is their book income per their financial statements. Notice there's no federal income tax expense estimates on here at all. We're going to be calculating our federal income tax, or just our income tax expense or benefit, as part of this process. So here's book income, and then these are all the things that represent differences between book income and taxable income. So like interest income, this is some municipal tax, some municipal interest from a city bond that is non-taxable, so it's being reversed out of book income, and you can see book income is being reduced over here in the taxable income column. Capital gains and losses, looks like we have a loss this year for book purposes. Those are not deductible unless you have gains, capital gains. So you can see that this loss is totally reversed, or not reversed, is adjusted out in arriving at taxable income. Gain on fixed asset dispositions. We had a gain for book purposes on a sale of some assets. We must have determined that the tax gain was bigger than the book gain, because we're adding $16,000 to this gain to get a tax gain of $70,000. Deferred compensation, we had a book expense of $300 for deferred compensation. It looks like our tax expense is even bigger, so we're taking a $450,000 tax deduction for this item, and so on and so forth, adjusting our book amounts to tax amounts. Notice that these are identified as either permanent or temporary in this left-hand column. So what we do is we calculate our differences, our permanent differences, and then our temporary differences, and figure out taxable income. So we've got a bunch of permanent differences that we identified, and we look at whether they're favorable or unfavorable, and we add them all up here to get a net number. So we have net favorable permanent differences of $350. That means we're net reducing our income by $350,000 for permanent differences. This example says she used the net permanent differences to find pre-tax net income. So we are adding back, or we're adjusting, I should say, our pre-tax net income by these permanent differences to get this thing called book equivalent of taxable income. It's really just book income after permanent differences are taken into account. So we've gotten rid of our permanent differences, we've handled our permanent differences in arriving at this book equivalent of taxable income. The next thing we have to do is identify and handle our temporary differences. I'll talk about that in the next video.